This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performance does not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk, and there's always the potential for loss. Your trading results may vary. No representations are being made that any software or training will guarantee profits or not result in losses from trading. This is the Premier Trade FOREX Report with Scott Norse.
Good afternoon, traders. I'm Scott Norse here with your FOREX Report. We are wrapping up the week. It's Friday, June 8th, 2007. We began the week with the U.S. dollar under pressure as we headed into ECB and BOE rate decisions. While most investors had been waiting for the ECB to hike rates for many months now, new speculation of a possible unexpected hike from the BOE was driving the pound higher. The European Central Bank raised rates as expected, and the Bank of England left rates on hold, which disappointed the market. Meanwhile, high-yielding currencies such as the Aussie and Kiwi were gaining big on the back of high interest rates and strong economic data. Australia this week posted much better than expected results in GDP and jobs, while the RBNZ unexpectedly took rates to a record 8%. This propelled the underlying currencies to new multi-year highs. However, the dollar made a big turn in the latter part of the week and is now headed for a great finish. With yen carry trades unwinding steadily through much of the week on the back of slumping stocks, the dollar had a better chance of getting a foothold in the broad market. The reason is that yen crosses will likely fall faster than the dollar yen, as the rallies have been much greater in the crosses, leaving them more vulnerable. On Thursday, when 10-year Treasury yields broke above 5% for the first time since August, big Wall Street firms began slashing bets on rate cuts for this year. Goldman Sachs, for example, changed its outlook for year-end rates from 4.5% to 5.25%, indicating the world's biggest securities firm now sees no move from the Fed until at least 2008. Other firms are also betting less on loosening as the FOMC maintains a hawkish stance on inflation. Additionally, a new Bloomberg report today showed that economists now expect U.S. growth at 2.6% for the second quarter, which should take the attention away from the final reading of first quarter GDP. This really does shift the picture a bit, and the greenback has responded very well to the adjustments. Now on to the big picture. Just a few days ago, we believed that we may need to change our tune to a slightly more bearish dollar in this week's big picture. For the last few weeks, we've maintained a slight tilt towards dollar shorts while still considering long dollar trades for the short term. Given the recent developments in interest rate and growth outlooks for the U.S., we are going to adjust more toward a neutral bias in the big picture. Again, we must emphasize that we are only giving the dollar so much credit because of the historic lows at which it is trading, thus giving the greenback more room to gain. Furthermore, we are not looking for longer-term trading opportunities in most majors at the moment. Perhaps we will see such opportunities in some cross pairs, but as we move further into the summer, we prefer to keep trades on for no longer than a week or two at a time. With our fresh outlook, we truly believe the greenback can gain further in the short term. Meanwhile, if global equities markets continue to falter, the yen may also see further appreciation, especially against the European currencies. Till next week, hope you enjoy your weekend. Take care.